We are just thrilled to have you all here joining us on for our investment update. This is an event that is always really enjoyed and appreciated by so many of our stakeholders, and we are so thankful for our investment committee members as well as our partner at Wells Fargo, Jim Beckett, for being able to join us today. A couple of things, just housekeeping things before we start. Down at the bottom of your panel, you'll see that you have access to a Q&A feature. As questions come up for you during the event, we encourage you to submit those through that Q&A feature. The chat feature has been disabled, so you won't be able to use that, but please let us know anything that comes to top of mind, clarifying questions, or just things that you'd like to know more about during the event. The sort of general agenda for today is we will start with our panel discussion with our investment committee members. We'll then have an update from Jim Beckett, our partner at Wells Fargo, and then we'll open it up to a Q&A session. So I'm going to hand it over to Kristina Koutrakas. She's our investment committee chair, and I'll let her take it from here. Thanks, Kristina.
Excellent. Good morning. Thank you, Katie. And thank you all for participating in today's event. These are obviously uncomfortable times, and this is not how we would like to go through this type of exercise. It's much nicer when we're sitting at Darden and having a lovely breakfast. But I have to say, it is a distinct honor to be part of the Community Foundation, and specifically to do what we do as professionals to steward the assets here for the future and specifically for generations to come. My name is Kristina Koutrakas, as Katie just said. I'm the Director of Portfolio Strategies for the Virginia Retirement System. I currently have the privilege to serve as the chair of this committee, which I think is an overstatement because the committee runs itself incredibly well, thanks to both its governance structure as well as the people who serve on it. I'm currently joined by three wonderful professionals who I have very much enjoyed getting to know over the past couple years. And we decided to come forth with as a slice of the investment committee today, not to overwhelm you with all of us, but to give you a chance to kind of ask us questions and have us walk you through how we look at the portfolio, how we think about the stewardship of these assets, and how kind of the whole process works. I'm going to turn the mic over and let people introduce themselves and take a few moments to discuss what brought them to the committee in the first place, how long they've been here. There's a couple that have been here for quite a while, but also to discuss their diverse backgrounds and how it helps the committee. And I will hand it over to Alice Handy, who really needs no introduction. Alice?
Well, I'm the oldest on the committee. I started back in 2003. And we do have term limits, but every time I ask them if they're going to invoke them, they say no. So we'll see how that works. But I was back in the very beginning when we decided to actually professionalize the committee and diversify the portfolio, et cetera. So my background is I started out at the Travelers Insurance Company. I worked there for 4 years in bond portfolio management. Moved down to Charlottesville in 2000 and, well, what had it been? I don't know, anyway, 1974. And I was the first investment officer at the University of Virginia. I did that for 29 years. And in 2003, I started my own company called Investure, which was an outsourced investment office for colleges and foundations. I retired from there, I guess, a year and a half ago, almost 2 years ago, whatever, a long time ago. And, but I'm still on this committee. I'm on a lot of other investment committees for not-for-profits. And so that's my background.
Fred, can we turn it over to you?
Sure. Hi, everybody. I'm Frederick Nolde. My ties to Charlottesville go back to when I graduated from UVA in 2003. I spent a few years up in New York at JP Morgan. Before coming back to Virginia, where I then spent about 10 years serving high net worth families, so their investment portfolios. And then about 5 and change years ago, I had the opportunity to join Investure, where as you just heard Alice founded that company. And so I've been there now for 5 years, and we serve as the investment office for a handful of nonprofit endowments and foundations. And I'm the newbie of the group here. I joined the committee at the beginning of this year, so this is all new to me. But it's been a great opportunity both to serve the community and to get to know a lot of people in the community, as well as all the members of the committee and board. So I'm learning as much as I think I'm giving at this point, but I've really enjoyed it thus far.
And Kristin.
Thank you, Kristina. So I have led the operations team at CornerStone Partners for nearly 9 years now. CornerStone is an outsourced chief investment office located here in Charlottesville, and we manage approximately $9 billion in assets exclusively for nonprofit clients across the U.S. So our clients include colleges, university, healthcare systems, and private foundation, among others. Our average client portfolio value is about $500 million. So it should be noted, I am the only one on the panel today not working directly in portfolio management. So as leader of CornerStone's investment operations team, I'm responsible for various client service functions such as performance reporting, portfolio reconciliation, portfolio administration, transaction processing, and investment-related audit and tax support. So I can actually say my career expands over 25 years now, good or bad. So prior to CornerStone, I spent a large chunk of my career in public accounting for well over a decade and continue to be an active CPA. And then prior to my career in public accounting, I worked for an investment bank up in Boston doing SEC reporting. So I believe my role on the committee is a little different than the others in that I bring more of an auditor's eye to the table with perhaps more of a focus on governance and compliance and rather than direct investment management. So in addition to the investment committee, I'm also a member of the audit committee, which puts me in a good position to share information across committees. With the portfolio being approximately 90% of our asset base, obviously it's a very key part of the audit. Let's see, and then probably one of my biggest undertakings since I've been on the committee is working with Jan to kind of reinvent the IPS. So that's kind of been a big chunk of what I've done in this past year. And so how did I find myself here today? Let's see, I first came to Charlottesville about, in the mid-'80s. When my dad relocated from Massachusetts to become a professor at UVA. So I can now say I spent most of my life in Charlottesville. Graduated UVA in '94. So I remember when the downtown mall was like very different than it is today. I remember when Fridays After 5 was on the other end of the mall, and I even remember Dave Matthews singing open mic nights. So I've been around quite a while, and I've seen significant changes in our community over that time. So by serving on the foundation has been very active and hands-on responsibility for me. I've been a part of the investment committee and the audit committee for just a little under 2 years, and I've been a board member for a little under 1 year. And I must say I have a huge amount of respect for the individuals leading the foundation, Brennan, Jan, Ebony, Katie, and really the entire team. I've seen firsthand how they've worked so diligently to raise and deploy millions of dollars in aid to those in need in our community. These are some of the most desperate and tragic times that I've personally lived through, and I'm grateful to be a part of this organization and working to support their incredible work. So that said, to the donors out there and to the foundation team, thank you for providing me the opportunity to be here today.
Well, Kristin leaves a very difficult act to follow. But what we wanted to do is, many of you have been with the foundation for a long time. To level set for some of the newer editions of the group, we wanted to kind of start with an overview for how the committee works and specifically how the portfolios are managed. For the purposes of this discussion, we're going to focus on the long-term pool. There is a short-term pool, but the long-term pool compromises, I think, about 97% of the assets, and that houses most of the long-term assets within the portfolio. So to turn it back to Kristin, could you talk a bit about the role of the investment committee in terms of the how we work together, but then also how we work with the board, given that you have the seat across multiple committees? without a mute.
So the governing board is ultimately responsible for appointing the investment committee members and selecting the chairperson, Kristina. I also want to note, in addition to the individuals here today, Leonard Sandridge and Fred Scott continue to serve on the committee and provide invaluable support to the foundation. The investment committee meets at least quarterly to review investments. We meet with Jim Beckett and his team from Wells Fargo. So in addition to the investment committee, Jan, Brennan, and Andy also attend these meetings. And then Jan typically provides the board with portfolio updates on a quarterly basis at the board meetings. So just as a reminder, the investment committee has selected Wells Fargo as our investment advisor for the public equity and real asset strategies. And accordingly, Wells Fargo is also responsible for manager selection within those classes. The investment committee is responsible for fixed income and alternatives manager selection. So currently we continue to use Agincourt out of Richmond for our fixed income program, and Blue Stem manages our alternatives, including hedge funds and private equity, and operating out of Charlottesville. So the long-term and the short-term portfolios currently amount to approximately 170 million, with 98% of that being attributable to the long-term pool. So in addition to the long-term and short-term pool, we also oversee about 40 million of separately invested funds, and they're currently largely held with Merrill Lynch and JP Morgan.
Alice, if we could turn over to you, as you look at the portfolio, can you provide an overview of the investment philosophy that the committee takes, but also how we think about asset allocation?
Sure. We think about this as a very long-term portfolio, so sort of perpetual funds out there from which we want to have a sustainable spending rate. And that's generally thought of as being somewhere between 4 and 5%. So, you know, inflation plus whatever we spend out of the whatever we spend out of the endowment. And so it needs by necessity, in order to keep that going, to have an equity bias. And so it has a really distinct equity bias. We have these funds with managers, so, you know, sort of traditional ones that you would think of equities and fixed income. As Kristin noted, we have Agincourt for a fixed income portfolio. But we also added Blue Stem because they were a local firm, and they added a little bit of private equity and hedge funds to the portfolio. They're not really a hedge fund, but they do hedge the portfolio occasionally, and they do have some managers in there that do it. But it was a really nice local alternative that we had here of somebody that cared about the community, and Michael Bills, that we could put money with and have a diversification in the portfolio that our participants, sorry, I didn't mean to call them clients, wouldn't otherwise have an advantage of having that in their portfolio. So we had that unique advantage of being here in Charlottesville. And so we think about it again, long-term, sustainable spending over long periods of time, growing with inflation.
Thank you, Alice. Fred, I'm sure that everyone thinks that our meetings are just full of fun and excitement, but could you talk a bit about how we work with the external managers? I mean, Alice was just talking through Blue Stem. We also have Agincourt and Wells Fargo, but can you provide some detail in terms of the oversight the committee provides to those investments?
Sure. So, you know, we meet formally as a committee on a quarterly basis and review the equity managers, as was discussed, are overseen by Wells Fargo, and then we review those on a quarterly basis, as well as real assets. And the fixed income manager, Agincourt, was appointed by the committee, and that is a manager based in Richmond that's been in the portfolio a very long time. And then, as Alice mentioned, Blue Stem is the alternatives manager. So the way it works is we meet with them in person, or I guess these days virtually, at least once a year. But that said, you know, several of us are involved in markets on a daily basis, and so interact and sort of overlap, I should say, with some of these managers in the market. So, for example, Blue Stem, you know, I'm familiar with personally just because I have a similar role and so know them well. We read the quarterly letters from these managers and also other periodic updates. So, you know, it's a real ongoing monitoring of the managers beyond just sort of the formal updates.
So this has been a very unprecedented year in many ways. When the pandemic hit, the global equity markets fell as much in 6 weeks as they had in 15 months over the financial crisis. And obviously that raises a lot of questions. The shift to working from home has spurred returns across a number of technology stocks that are truly unprecedented. And it calls for some to believe that we're in a tech bubble. Jim Beckett's going to provide an overview of the portfolio's performance at the end of the session. But one of the things that we wanted to do was talk a bit about how the portfolio has weathered the year and give some thoughts and provide a brief synopsis of where we are in terms of our thinking at the committee level. So Fred, if I kick it back to you, would you mind sharing some of your thoughts in terms of the events of the year, but also how the portfolio is set up to mitigate some of the extremity of these moves in the stock market?
Sure. Yeah, as Chris mentioned, I mean, it was an extraordinary year in terms of the downturn was, it was extremely sharp, but then it was also recovered faster than ever. So it was the shortest bear market in history. The S&P 500 declined about 35% peak to trough, but then recovered in a matter of months and is now, at all-time highs. The Fed, I'd say, learned a lot from the financial crisis of 2008, and this time around it was a much quicker response, both from the fiscal side and the monetary side. So you've had trillions and trillions and trillions of dollars globally, well into the tens of trillions of stimulus, which have supported the markets and the economies. But it still is a sort of strange market that the economy and markets are somewhat bifurcated, and they don't necessarily, they don't seem to be linked to some extent. It's really kind of a tale of two worlds where you've got these tech stocks, as Chris mentioned, and a handful of other areas that seem to have really benefited from the coronavirus situation, whereas other sectors, primarily more economically and cyclically sensitive, such as aviation and these types of things, have really been hurt. So it's a very strange environment, but fortunately the portfolio that that you're invested in is diversified across a lot of different asset classes, and it's also pretty liquid relative to many other types of sort of endowment type portfolios, and it's long term. And so the benefits of all that, there were no decisions, there was no need to force sell anything at the bottom to meet redemptions or anything like that. So we very much benefit from the long-term approach, the transparency of the portfolio. So, we can look through and see what is owned. And then just, the other thing I'd point out is, you may have heard a lot in the last few years about the rise of passive management. And this portfolio is primarily actively managed, and yet has done extraordinarily well, the active managers kind of across the board. So it's really remarkable, both in the alternatives, the blue stem, the fixed income, and then the equity managers. And so the portfolio has outperformed, even the passive indices, which has been extremely difficult the last few years for most active managers.
Alice, is there any thoughts that you would like to share?
Yeah, we were talking about, I serve on a lot of investment committees, and I guess one of the things that, just keeps coming up, are there things out there that we should really worry about? And, I've been through a lot of market crises. So we had one in '74 when I first came to UVA. The market had, that was considered the Great Recession before the last Great Recession. And then we had one in the late '80s when portfolio insurance blew up. And then we had this one in 2007-8, and then this one. The difference with this one, though, was that there was and I think it's important to realize that there was something different than just the economy collapsing, and it was fear of death, right? I mean, fear of physical harm to you as opposed to just economic harm. And I think that really changed the dynamics that were out there. And I think it's very interesting. Also, we learned that external forces, and I think we'll have to consider this and figure out how to deal with it, such as China, can influence how we do things. I mean, they can control, if we've outsourced everything to them, how do we get it back here? And should we keep thinking about that? So I think there's a lot of issues out there that we need to probably not necessarily wrestle with, but at least understand, from Jim with our managers, how they're thinking about them. Because I think they're really big issues out there that are very different from any other crisis. I think we got pretty good at doing financial crises. I don't know that we're very good at a health crisis yet, combined with the financial crises.
So in terms of having those conversations with our managers, Kristin, can you talk through just the potentially mundane topic, but how we work in terms of providing governance and oversight for the portfolio, and specifically like how what's the role of the documents that we provide, the investment policy statements, but how we state how what we do matters.
Sure thing. Yeah, so some of you might want to go get a cup of coffee. So just kidding. This is important stuff. But as I mentioned earlier, we conducted an overhaul of the IPS, the investment policy statement this year. Though we review it annually, the last formal update took place in 2014. So we felt like this is a good time to kind of think about best practices. And so some of our objectives in performing this update included producing a more comprehensive standalone document applicable to both the long-term pool and the much smaller short-term pool. We used to have two separate documents, one that we called the main pool and another one the short-term pool. And then we moved the specifics relating to each pool to be exhibits to the main IPS. So that would give us more flexibility in just changing some of the nuances of the underlying pools, or perhaps even allowing us to, nimbly add another pool, such as an intermediate pool, pending the needs of our investor base. So we clarified and provided more details about the roles and responsibility of the board, the committee, the investment advisor, and the director of finance. So they are now very specifically laid out within the IPS. We tweaked and incorporated the investment philosophy within the document. It used to be a standalone document, though it's still largely centered on active investment with a long-term outlook. We restructured our asset allocation targets and ranges. So specifically, we collapsed the subclasses within the public equities strategy to give Jim more flexibility in sub-strategy selection and weighting. So we now have an allocation to global equities and not the previous 5 subcategories of large cap, mid cap, small cap, developed, international, emerging markets. And then we also expanded the asset allocation ranges for real assets. We increased it by 5%, and we added another 10% to the alternatives range. We formalized or memorialized our various portfolio asset class benchmarks and incorporated the annual board approved spending policy within the document. So our minimum return needs to be our spending rate plus inflation. So we want to make sure our investment advisor is managing to that, and that's approved annually. So we also added the requirement to conduct periodic ESG reviews to ensure there are no material misalignments with the foundation assets. And so as an aside, based on last year's public equity review that Jim performed, we actually appear to be performing fairly well compared to other ESG focused investments. And this will be a big focus of the committee in the coming year, ESG and mission-based investing. And then lastly, we formalized the requirement to perform face-to-face annual due diligence meetings by at least 2 of the investment committee members, and then share information about those meetings to the entire committee. So because we now have so many specifics outlined in the document, we feel it'll hold us more accountable, and that other interested parties will benefit from just a more consolidated, thorough, and transparent IPS.
Thank you, Kristin. So kind of bringing everything to the close, one thing that we wanted to touch on was the view going forward. So as we're entering the final months of the year, many people are talking about the upcoming US election. People are asking questions about what the world looks like with interest rates so low, and potentially a conversation about going negative, and what the outlook for inflation is. And all of that is on top of the continued uncertainty around COVID. So Alice, could you please kick us off with your thoughts and tell us, where's the world going and how should we be investing right now?
Yeah, I mean, I wish I knew. That would be lovely. I think there's a lot of uncertainty out there, but I've lived through so many of these now. I just feel like we should ride this one out. I think we're well positioned. I think we've thought about it hard. We've been careful about how we've invested. And I think it's very difficult to start moving your portfolio around. Obviously, if interest rates go negative, that's an issue. And, you know, in hindsight, we probably should have been a little bit longer in our bond portfolio, and weren't. But, you know, those are all great things to guess at later. But I think that the portfolio is pretty conservatively invested. And I think we're in territory now that we really don't know where it's going. And I think that, you know, holding through it, given that we have a very long perspective and a low spending rate, we should be in fine shape.
Fred, what about the equity portfolio? What are your thoughts, particularly around the election?
Yeah, I mean, it's, you know, if this year is an indicator of anything, it just shows how hard it is to sometimes take events and translate them to market impact. You know, if somebody had told you coming into this year that there was going to be a global pandemic, a drastic drop in, you know, economic activity and earnings, et cetera, you know, who would have ever thought we'd be at all-time highs, you know, in the stock market. So, you know, elections, I mean, we saw it 4 years ago when Trump won. It was initially viewed by the market heading into as very negative, and yet the market then rebounded significantly shortly after the election. So it's really, really hard to predict. The market really seems to be looking through the election to some extent into next year, into, you know, possibly having some sort of vaccine or other things, and really so looking through to an economic recovery. That's what markets do. They discount the future. And so that's really, you know, what we think why a lot of what the market's doing what it is. If you get a vaccine, you have, regardless of who wins, significant stimulus on the horizon. And, you know, there's a real possibility that some of the sectors and areas that have lagged really could pick up. And so despite some of the concerns about maybe valuations in technology and other areas, there's other areas that, you know, really haven't done as well. And even just this morning, JP Morgan and Citigroup both reported earnings and came in sort of better than expected. So you're already seeing a little bit of that kind of early inning economic recovery in some of the more kind of conventional areas and sectors of the market. So, you know, all else equal, I think to Alice's point, you just sort of ride through this. You can't try to predict an election, or even if you could predict the election, I'm not sure you know the market outcome. So just ride through it. The portfolio has been doing well, as Jim will update shortly. And, you know, there's still potential upside in several areas.
And I guess if there's one more question that came in, which I'll send it back to Alice. How do you think about meeting our long-term spending rate with interest rates so low?
Well, as I said, in order to be at 70, in order to have the spending rate we have and be growing at inflation, you have to be a primarily equity portfolio anyway. So it is tough. I mean, it makes it harder. And perhaps you actually have more in equity and less in fixed income because of it, because you aren't going to get anything out of your fixed income. But those are all discussions that we'll have to have as we go through this. But I'm still sort of a person to slog through this, and we'll see where we end up in the end. That, you know, we aren't going to be at negative interest rates and low interest rates forever. It's just not sustainable, and so we'll have to figure out what happens if we can make it through before that period.
Brilliant. So I'm going to take this opportunity to turn it over to Jim Beckett, because what you really want to know about is how the portfolio is done. So Jim, otherwise known as Jan Dorman on this webinar.
Thanks, Chris. Can you hear me okay? Great. And I'm sharing my screen now, so hopefully you can see that for the presentation. So as a lot of the presenters have articulated, it's been an interesting period of time. I won't rehash the entirety of the year, but suffice to say, 2020 started off much like the way 2019 ended. Markets were up and doing very well prior to COVID. Fred, I think, touched on the fact that we had one of the quickest bear markets by historical standards. And equally as impressive was the corresponding rebound that we've witnessed since the March lows. S&P up something like 50% through September 30th off of those March lows. So the challenges still remain. I've just put a few of the headwinds and tailwinds that we see on here. Again, I think Fred summed it up very, very well, that there is a bit of a disconnect between the economy, generally speaking, and kind of the broad economic indicators that we look at and how markets are performing. And much of that optimism is really driven by the expectation that the current health issues affecting not only this country but globally will come to an end at some point, and markets are looking beyond the next day or two in terms of how they'll perform, and we'll get back to some level of normal economic activity and behavior, and that'll be driven by equity prices and financial market prices. So the next page is really just a quick update on the economic outlook, and again, you can see returning in our expectations for 2021 back to levels that we saw prior to COVID influence on the markets. 2020, by all accounts, is going to be a negative year. I will say it was bad in the second quarter. We knew that going in. The numbers were terrible in terms of some of the worst quarterly economic data that has ever been measured. But again, I think the one solace point that the market is taking from this is it's been less bad than expected, if that makes sense from an economic perspective. And again, it's not lost on me that from a pure health and human suffering perspective, this has been a terrible tragedy, and not trying to in any way mitigate that. But what the markets are most interested in is looking out into the future as a discounting mechanism and saying, what can we expect in the coming year or two? That translates then obviously with higher expectations for economic improvement to where we see markets. And again, we're showing here the 2021 year-end forecast for various market indices, all up relative to obviously where we are here in 2020. And so growth in the underlying economic situation is expected to bolster stock performance over time. That's what we're interested in, that's what we're looking for, and that's what we're trying to employ within the portfolio. This just serves as a reminder kind of historically of what bull markets have looked like, both in terms of magnitude, in terms of percent return, and length of time, with the average being this gray circle right here kind of in the middle of the plot. So we're up something akin to a 200% return over about a 60-month or almost 5-year window. Obviously, with the events earlier this year that truncated the previous bull market, and so we've now begun a new one. We're up very dramatically, up about 50 or so percent, as I mentioned earlier, from the March lows, but still only about 6 months or so into this one. And again, I would serve to remind everybody that a bull market does not necessarily mean markets don't ever go down again during that bull market. It just means they don't generally go down more than about 20% from an expectational standpoint. It's very typical to see a market drop anywhere from 10 to 11, 12%. I think historically, we've averaged a 10% decline about every 11 months over the long term. This just goes back and looks at how we've performed for different viral outbreaks in the past. And again, some of this has had other significant overlays to it. I would note as an example, just the SARS 2002, 2003, which is the first kind of shaded area there. That kind of happened to also correspond with the tech bubble bursting back during that period of time. So maybe not a true indication of just what a viral outbreak will do, but as Alice had mentioned earlier, we've seen an awful lot of these kinds of market dislocations, regardless of what the cause might have been. And markets have done well long term, and investors have been rewarded long term for remaining patient and staying focused on that long term. Obviously, we have a presidential election coming up. We're now 3 weeks away. We've taken a look at how stocks have performed and behaved during those presidential election years. Historically, the S&P's generated about a 9% average return in the 12 months leading up to the presidential election, and it's averaged about a 13% return in the 12 months immediately following the presidential election on average. Both of those are higher, by the way, than the roughly 8% or so return that the S&P has done per year since the early 80s. So, you know, markets, I don't want to say don't pay attention to elections. They obviously do. Elections obviously have some consequence to the markets. But our research would suggest that more important things are economic data, like the underlying direction and level of GDP, for example, can explain what's going on with the stock markets much more than whatever happens in the election cycle. Election cycles tend to be a little more short-term in nature, and we're not wholesale making changes to the portfolio simply because of the results of the election. Valuations have certainly been stretched as earnings have fallen through the pandemic, as we've shut down the markets and the economy and businesses have suffered. We've watched a corresponding jump up in valuations. And even if we move forward the equities that we're, the valuation levels for earnings that we're expecting next year, these valuation levels are still inflated versus what we would like to see longer term. So cautiously optimistic would be the way I would describe going forward from an equities perspective. We're still expecting the markets to move higher and for underlying economic data to improve, but valuation is something certainly to be paying attention to and how much risk we're bearing in the portfolio. This is just a quick recap by asset class. This data was through August 31st. So you can see of note, US large cap equity being the best performer during the year-to-date period. And notably, fixed income, 4 out of the 5 top performing asset classes were fixed income based. I think that speaks to the volatility and concerns of investors as a result of the COVID-19 uncertainties. This is the actual CACF long-term portfolio as of September 30th. So just a quick allocation summary. You can see where we were allocated as of the end of the second quarter, and then also the end of the third quarter as of 9/30. As Alice mentioned, it's fairly heavily skewed towards the equity and alternative space, in large measure because we're not getting a significant amount of return from cash and fixed income at this point. It used to be cash and fixed income could pay you something as a safe haven. It's pretty much relegated to just a safe haven piece of the portfolio at this point. Although again, it is worth noting that at least so far this year, fixed income has been additive from a performance perspective to the portfolio. The policy ranges that you see there as well, those are dictated by the investment policy statement. And again, my job is really to coordinate the vision and direction of the Foundation's investment committee and board to help reach the long-term goals and make sure that we're in compliance with all of those policy documents. This next slide just breaks down the information a tad bit further and shows you the breakout on more of a subclass level. So within the equity component, you see there the breakdown between large, mid, small, international, and emerging markets. We've generally been a little more interested in overweighting the portfolio towards the US. That's been the better place to be from a performance perspective. We think the rule of law, the recovery potential, the economic engines, if you will, that drive the underlying economies, the US is the better place to be. We haven't given up on international by any stretch of the imagination, but we're trying to overweight the US. And even within the US, we've generally been a little more overweight towards the large mid-cap, again, from a safety perspective going forward, quality of balance sheet, et cetera. That dynamic is starting to change a little bit. We're now taking a look at small caps and thinking that represents an area where we may be willing to be adding some money here shortly. And we are running a little higher levels of cash than what we would otherwise normally be. I think just again, given some of the levels of uncertainty that we're seeing and waiting for some buying opportunities to present themselves in the short run. There's been a lot of discussion about growth versus value within the portfolio. And within investing generally, growth as a style or strategy of management has significantly outperformed. And when I say significantly, in some areas we're talking 20, 30, 35 full percentage points of outperformance versus their value counterparts. We've not leaned dramatically towards growth deliberately, but as a result of performance, the portfolio has skewed that way. We generally are trying to keep about a 50-50 balance between growth and value. Any opportunities we have to rebalance the portfolio, we'll probably be looking towards the value side of things as we go forward. This slide is just a nice summary of net of investment management fees or after investment management fees on the portfolio. This top section is all through the end of December 31st, 2019, as we only update this slide annually. But down in the bottom right-hand corner here, we've got a preliminary estimate as of September 30th for the foundation portfolio. Bluestem, we don't have final audited figures for them just yet. We typically get that about 4 to 6 weeks after the quarter end. But again, a strong continuation on performance thus far year to date for the 9 months this year. The foundation portfolio estimates up just under 10%, 9.6, with the benchmark being about 5.6. And again, that benchmark is footnoted on the left-hand side there. That's a 75% MSCI All Country World Index and the 25% 7 to 10 year Treasury benchmark. So consistent long-term performance. The portfolio has outperformed, I believe it's now, pardon me, I think it's, yeah, there it is, 10 of the past 15 years. So about 2/3 of the time, roughly, we've outperformed on a calendar year basis. And equally as important, whenever we've suffered a loss during one of the calendar years, that loss has been less than the benchmark would suggest. So I can tell you that the investment committee, through their questions with me and through our meetings, pay close attention to the risk levels that are in the portfolio, as well as the return expectations of the portfolio. So very pleased with where things stand so far year to date, despite all the economic uncertainties. Kristina, I'll throw that back to you.
Excellent. Thank you so much, Jim. If there's any additional questions, there's a Q&A button down at the bottom of your screen, so you can type it there. The one other thing that I think is super important to talk about is, as everyone's aware, the foundation has embarked upon an equity journey in terms of thinking about how the work that we do impacts our neighbors, and also to acknowledge the role that race, gender, and other identity characteristics play in terms of how our community functions. This naturally brings forth some questions in terms of how we think about that within the investment portfolio. And it's important to say that currently the investment committee does not have a mandate to take any of these types of things under consideration. We have started to adopt a viewpoint to evaluate the portfolio from an ESG perspective and to look at ESG scoring versus the benchmarks and see how the portfolio stacks up. We are also exploring the implications and the benefits of thinking about these types of perspectives, but that will be a process that we'll undertake over the course of the next probably several years. And it's an ongoing exercise and an active dialogue. The one thing that I would say is that we would invite the thoughts and feedbacks from our stakeholders as we go through this process and consider what's most important and most appropriate for the investment portfolio. With that, I don't see any additional Q&A that has come in. There is one question in terms of how we think about the racial diversity of our managers. And as mentioned, this part of that ongoing dialogue. So with that, I think I will turn it back to Katie. And before I do that, I wanted to thank you all for your time today. Thank you for your indulgence as we go through some potentially very boring parts of this, but it's important to talk through the process, the philosophy, and kind of how we think about the overall governance structure of the investment portfolio when we come to managing assets for the foundation. So thank you all for your time. And we have so much trouble with mutes.
Thank you so much, Kristina. And all of our panelists. I can't thank you all enough so much for your time today. I so appreciate our attendees and the questions that you've asked. If things come up for you later, always feel free to reach out to Jan Dorman or me, and we will be happy to connect you with the right folks and make sure you have what you need in order to feel comfortable about where we are with our investments and ensuring that those are being well cared for. So again, thank you all so much for your time. You've got about 45 minutes back in your life that you didn't know you'd have, and that's wonderful news for all of us. So thank you all. Really appreciate your time, and I hope you all have a wonderful day.